this morning. David, great having you. There is some bit of choppiness, David, with regard to how crude is behaving, and also given the way how global developments are panning out. Is this going to be slightly more long drawn than most were anticipating in terms of the situation in West Asia?
I think some things are becoming clear. One is that the deal which is being negotiated between Iran and Oman settles nothing. It basically confers control of the Gulf on Iran. Oman is no match for Iran, and the ships going in and out of the Gulf will have to go in through the Iranian waterway, so they control that. And they come out through a waterway which is only jointly controlled by Oman and Iran. So Iran remains in the driving seat, and the Gulf remains the nuclear weapon of Iran, and they will not give it up. The result of that is that the oil flows will not normalize. You may get 25% of normal rates, which were, if I can remind you, 130 vessels a day, of which 20 were VLCC tankers. So you might get 25% of that at most. If you did, that would not settle any problems about the deficit in global supply for crude oil. It would actually leave it at approximately 8 to 9 million barrels a day, and inventories would continue to decline. Now, what is getting worse is that China, which stopped importing oil or cut its oil imports by 40%, or 4.6 million barrels a day, is now importing again at full rates, so 8 or 9 million barrels a day. So China is now sucking oil out of the global market. And of course, Russia is now losing approximately 1.6 to 2 million barrels a day of crude oil and refined product exports, and is actually having to import refined products like gasoline. So that's being taken out of the market. So essentially, any improvement you get from the Gulf under a botched deal, which is fundamentally a defeat for Trump, any improvement you get will be actually more than fully offset by declines in the availability of oil due to other sources, China and Russia.
Right. David, the other thing I wanted to talk about was what's happening on the Japan 10-year yield, right? I mean, it's now climbing towards the 2.9% mark as debt piles up. What does the situation look like right now for global bond markets, for Japan's economy, and of course, yen carry trade thereafter?
Well, that's a lot of things, but I will attempt to wrap my little mind around them. I think the first thing we have to say is that intervention like the US and Japan did to support the yen only works if you have the right policies to match that intervention. And in the case of Japan, the right policies did not happen. The right policies would be a continuous trend, sharp trend, in normalizing Japanese interest rates, taking them from 1% to 2.5% at least. Never happened. Total silence. The other is that the fiscal deficit is now going to push Japan's fiscal deficit above 6% for the year. Totally unsustainable in an economy with nearly 220% of debt to GDP ratio. So essentially what you're seeing is a mismatch. Now, I think what that does is to say that people think that the intervention is not credible and that therefore the carry trade is intact. So the total reversal of the carry trade doesn't happen, which of course means that the outcome of the intervention on the yen is not that which was sought. And you will start to see the yen giving up its gains because the policies do not match the intervention.
Morning, you're right. You're already seeing the yen, depreciating, is going back to 158, 159. But do you think that the Japanese government will come in hard to support the yen at this point in time and prevent further depreciation?
Well, it's possible, but you're then flushing good money after bad money down the loo. You're not actually doing anything except flushing the loo. And the reason for that is very simple. Unless Japan alters its underlying policies, monetary policy and fiscal policy, you have no reason for the yen not to be weak. And frankly, you are not going to be able to stop the carry trade because the difference between yen interest rates and say US dollar interest rates is so big that it actually pays you and continues to pay you to borrow yen and buy dollars. So they can intervene as much as they like, but unless they actually make some coherent, consistent sense out of monetary and fiscal policies to match yen intervention, they are simply flushing, good money after bad.
David, do you once again see a rush for safer havens like gold? I mean, it's been consolidating last 5 months. Do you think it's poised for further up move?
Look, I think gold is building a base. I'm not very good at, chartism, but it seems to me gold doesn't want to really go below 4,000 and doesn't really want to go up again. So when will it go up? It will go up again as a greater chaos starts to unfold in the United States. The regime becomes more fragile, more unpredictable. And as I've often said to you, dying fish flap the hardest. And I think once that starts, the instability will make people start to buy gold again. But I would also say we're probably moving towards a major food crisis in the world, which nobody's talking about, where food prices go up because the war in the Black Sea, the Marushka war, where the Ukrainians are taking out the Russian ships, and that is going to take about 5% of the world wheat out of the international markets, which could push up global inflation by 3 percentage points. So once you start to see that, I think gold will get its new role, going back to an old role, which is as an inflation hedge. At the moment, it's a geopolitical hedge. Now, I think you will see a new role for gold in the coming year, which will be as an inflation hedge.
David, last off, just trying to understand, how should a capital allocator work at this point in time? How do you see US markets looking versus Korea, Taiwan, some of the hotter markets, at least over the last year and a half, versus India? Just give us your sense.
Well, look, my sense is that India is going to have its day. Now, you might say it's rather an odd thing to say, but the fact that India is not overextended into the US model of AI is probably going to be a big advantage for India going forwards, because the US model for AI is a poor model for AI. It is financed in entirely the wrong way, and the pricing is unsustainable because China is much more competitive and can produce just as good a product. So you don't want to be in Korea and you don't want to be in Taiwan, because these are suppliers to the US, really, not to China. And they are also illogical retail-driven markets, which react in ways which are rather like a drunk trying to find his way home after a binge, but he doesn't know where he lives. I honestly don't want to be in those markets because of the way that they actually behave. So India, I think, will have its day, simply because it's really quite a good economy, even if it is suffering from many of the influences of choke points. But I think that you don't want to get into markets which are actually supplier economies to the USAI boom, because that is unsustainable.
David, it was a pleasure talking to you today. Thank you very much for joining us this morning.